Joining me now, we've got Jason Benowitz, C.I. Siegel, Bryant and Hamill Asset Management Senior Portfolio Manager. Great to have you here with us in studio. You actually say the AI infrastructure trade is not over. How should investors be looking at the space right now?
Yeah, thanks for the question. So we think that there's the AI adoption and the infrastructure that will be deployed to enable it, that tailwind will persist. And so there are a group of companies that are publicly traded that are likely to benefit from this. And the reason that we have this conviction is, first, just if you listen to the first quarter earnings reports from the hyperscale companies, so they all told us that they were either going to maintain their capital expenditure for the year or increase it. So we know that they're investing. And then the second thing that we see is when we look at the private funding markets, here there are companies that are privately held that are building large language models. You know, a prominent example would be OpenAI. They continue to raise funds at increasing valuations. We know those funds will be deployed. And also there are private funds being raised both by private equity firms as well as sovereigns. And here the investments are going to go into data centers as well as the electric power generation that will be needed to power those centers. And so with all of that money flowing, we think the trade will persist.
And so with that in mind, who are the biggest and best positioned winners as a result of the continuation of that AI infrastructure trade?
Well, the way that I would look at it, I would think about the Magnificent Seven and then the other companies.
Okay.
And so let me first talk about the Mag 7. So here they certainly benefit from the persistence of the AI tailwind. And so that would be a positive. But really our view on this cohort is more mixed. And the reason for that is they face sort of unique risks that we don't see elsewhere. So the biggest one being antitrust scrutiny by the administration. And there are a number of trials that are ongoing, and we think more will come. And then, in addition to that, many of them are vulnerable to trade disruption. We know that AI is something that for national security reasons, it's going to limit the ability of these US domiciled companies to be able to sell into China to the way that they might otherwise. And so that's another factor that could be a headwind there. And so we think maybe it's better to think elsewhere and look at companies. I referenced already the idea of providing the electric power or the other equipment that goes into the data centers. And we think these might be better ways to play it.
When you think about what we're waiting for with the anticipated Nvidia earnings report, which everybody and their mother is going to be watching at the end of the day, what do you need to hear from Nvidia to further securitize the thesis around the AI trade right now?
So, we think that the demand for Nvidia's products is tremendous and it's there. And the question is, can the company execute? So what we've seen over the last few years is quarter after quarter, they increase the amount of supply availability. They grow the supply chain such that they can deliver an increasing amount of chips and book higher and higher revenue. And so there is some concern that because of the ability to deploy their most latest chips, each version that's more advanced becomes harder and harder to manufacture. Well, they run into sort of an engineering stumbling block related to that. And we see investors poring over various points within the supply chain, for example, the server assembly, to see if that's going to happen or not. And when we finally hear from the company, we'll kind of get the answer to that question. And that may be what determines how the stock reacts to earnings.
One of the other smart ways to invest in the AI infrastructure, and we've seen this trade really balloon over the course of the last year, it's in the liquid cooling systems that's necessary for data centers here. How are you kind of looking across all of the inputs that are necessary to keep the generative AI servers, the data centers, continuing to keep that going over an extended period of time?
Yeah, so we think that this is sort of a unique opportunity to invest in water and water-related infrastructure, and we're excited about this for a number of reasons. So we can start off, setting the data centers aside, just thinking about how populations are growing in arid areas like the US Southwest or the Middle East, and so that's a tailwind for the sector broadly. And then on top of that, the EPA recently designated a new chemical entity, PFAS or forever chemicals, as something that needs to be remediated both in water as well as in the soil of environmental sites. And that creates a unique opportunity for companies that play in the water space. And then we get to what you were describing, which is both to produce the most advanced chips, ultra pure water is required in the chip fab manufacturing plants. And then on top of that, liquid cooling is required to operate them in the data centers when you're talking about the most advanced chips. That's happening more and more. So this creates a whole ecosystem that might benefit from these trends. And I just want to close by saying, when people heard that Taiwan Semiconductor was spending more than $100 billion in the state of Arizona to build its new advanced chip fab, there were a lot of thoughts that went through people's minds. But what I heard was that this is a desert economy. The state has a law that says that if you're going to build a new industrial process, it has to be water neutral over a long period of time. And there's just a tremendous amount of water and wastewater infrastructure and recycling that's going to be required to make that plant run.
A few years back, we wouldn't have been able to have this entire conversation without even mentioning the Fed and what that means for portfolios. How are you kind of evaluating the Fed and what they've communicated to this point in time versus what the markets are anticipating?
So I think that I'm excited about the Fed as being perhaps a tailwind for stocks to continue to move higher this year. And that's based on my view that the Fed wants to reduce rates. So we're in a rate reduction cycle. It's been paused since December, but I think at some point it will re-engage with reducing rates further. They feel like rates being held at the level that they are restrains the economy and makes, basically weighs on the labor market. But what they need to see is inflation expectations over the long term being locked down further such that they can continue to reduce. So I think what the markets are pricing in right now is the first rate reduction coming in September. I think that's a reasonable expectation. And when the Fed is able to resume rates because inflation is tamped down enough, that might be a catalyst for stock markets to move higher from there.
Jason, great to see you. Thanks so much for taking the time here in studio.
Thanks, Brett.